March 2013, Cyprus. A small business owner named Christos walked into his bank to withdraw cash for his daughter's wedding. The doors were locked. The ATMs were dark. A handwritten sign taped to the glass simply said the bank would reopen soon. 2 weeks later, when the doors finally opened, Christos checked his balance. Half of his life savings was gone. It wasn't stolen by hackers. It wasn't taken by robbers. It was seized by his own government to save the bank. When the dust settled, the Eurogroup chief didn't apologize. He looked into the cameras and said Cyprus should be a template for future bank failures across Europe. That word, template, should worry you. Because while everyone was watching the crisis in Europe, the United States Congress had already built the exact same machinery here. You probably assume this can't happen in America, but it already did once. And what happened next reveals exactly how this works. April 5th, 1933. Washington, D.C. President Franklin Roosevelt signed Executive Order 6102. With the stroke of a pen, he made it illegal for any American citizen to own gold. Americans had 26 days to surrender their wealth to the Federal Reserve. The penalty for refusal, a $10,000 fine, equivalent to $240,000 today, or up to 10 years in federal prison. They paid you $20.67 per troy ounce. Non-negotiable. Most people complied, but one man decided to fight back. And what happened to him tells you everything about what your bank account actually is. A New York attorney named Frederick Barber Campbell had over 5,000 ounces of gold stored at Chase National Bank. When he went to withdraw it, the bank refused. Campbell sued. He argued the gold was his private property. He lost. And the reason he lost is the key to understanding everything that comes next. The court effectively ruled that when Campbell deposited his gold into the bank, he transferred the legal title of that gold to the bank. It was no longer his property. It was the bank's asset. In exchange, he received a promise, an IOU. Campbell got his $20.67 per ounce. Less than a year later, Roosevelt signed the Gold Reserve Act. It changed the official gold price to $35 per ounce. Notice the sequence. They paid you $20. Then they changed the price to $35. The government made $15 on every ounce you were forced to surrender. Over 2,600 metric tons were collected. Historians estimate only 20 to 25% of Americans voluntarily complied. Gold ownership remained illegal for 41 years. Now here's why this matters to you today, and why Cyprus wasn't an accident. The Campbell ruling isn't ancient history. It's the foundation of modern banking law. And it applies to every dollar in your checking account. When you deposit a paycheck, you're not putting money in a vault. You're legally lending money to the bank. You become what is known as an unsecured creditor. A Cyprus court ruled in 2022, quote, "From the moment that monies are deposited with a bank, they cease being an asset of the depositor, but rather become an asset of the bank." This isn't interpretation. This is how courts define the relationship. Drop a comment if you already knew this. Most people have no idea that their deposit legally belongs to the bank, not them. Christos in Cyprus found out what unsecured creditor means the hard way. When the bank went under, he wasn't a customer who lost his money. He was a lender who made a bad loan. At Likey Bank, depositors received approximately 6 cents on the euro. 30 years of savings reduced to pocket change. But Cyprus was 2013. Surely the U.S. has better protections. Now let me show you what Congress actually built. In 2010, they passed the Dodd-Frank Wall Street Reform Act. The marketing was clear. They told us this law would end taxpayer bailouts. No more using public money to save Wall Street. But they didn't explain what replaced the bailout. And this is the part that never made the news. Depositor bail-ins. Title II of the Act created something called Orderly Liquidation Authority. It gives the FDIC the power to seize a failing bank, and instead of using tax dollars to plug the hole, they can write down the liabilities. That is legal language for reducing what they owe you. Under this framework, your savings can be converted into equity. You go to sleep with cash in your checking account. You wake up with shares in a failing bank. But it gets worse. Because even if you accept being a creditor, you're not at the front of the line. There's a group that legally cuts ahead of you, and they're holding $230 trillion in claims. Derivatives traders. The largest U.S. banks hold over $230 trillion in derivatives exposure. That is approximately 8 times the size of the entire American economy. Under the 2005 Bankruptcy Abuse Prevention Act, these contracts have super priority status. JP Morgan and Bank of America both hold massive derivatives positions commingled with their depository operations. Your checking account and their derivatives exposure sit in the same institution. Imagine a sinking ship. The lifeboats are the remaining assets in the bank. Under current law, derivatives counterparties get the first seats. They can seize collateral and close out their positions before the resolution process even begins. You, the depositor, you're standing on the deck waiting for what's left. Now, the counterargument is obvious. What about Silicon Valley Bank? The government saved everyone. That's true, and that's exactly what reveals how this system actually operates. In March 2023, SVB suffered the fastest bank run in history. $42 billion withdrawn in a single day. 88 to 94% of those deposits were uninsured. Legally, those depositors were unsecured creditors who should have absorbed losses. But the government invoked a systemic risk exception and protected them anyway. Why? Because SVB had $209 billion in assets. It was small enough to save, but visible enough to cause panic if they didn't. They saved SVB because they could afford to. The question is, what happens when they can't? Look at the math. Total uninsured deposits in the U.S. banking system, between $7 and $8 trillion. The FDIC insurance fund, approximately $119 billion. That's 1.5 pennies for every uninsured dollar. If just 2% of uninsured deposits require protection at the same time, the insurance fund goes to zero. The banks with the highest uninsured deposit concentrations, in 2022, Silicon Valley Bank at 93% failed. Signature Bank at 89% failed. The pattern is already visible. They saved SVB to stop the bleeding. But if a crisis hits a global systemically important bank, like JP Morgan or Wells Fargo, the insurance fund becomes a rounding error. That's when they unlock Title II. That's when they use the Cyprus template. And here's why there won't be any warning. This is an improvised policy. It's internationally coordinated. In 2013, the G20 directed the Financial Stability Board to standardize this process globally. By 2015, the major economies had agreed on total loss-absorbing capacity requirements. That's the technical term for assets that can be seized from creditors when needed. Cyprus wasn't an accident. It was implementation. Frederick Campbell thought his gold was safe because he had a contract. The court ruled that government emergency powers overrode his contract. Christos thought his euros were safe because it was a bank. The government told him he was an investor in a failed institution. In 1933, Roosevelt gave Americans 26 days to turn in their gold. In 2013, the people of Cyprus got a weekend. The Orderly Liquidation Authority requires no advance warning. A 2/3 vote of the Federal Reserve Board and the Treasury Secretary is all it takes. By the time it's announced, the write-down has already happened. The legal framework exists. The international coordination is complete. The precedent has been set. The math is public. Understanding the structure doesn't guarantee safety. But it's difficult to navigate a system you don't know exists. The history they don't teach is the history that protects you. Most people learn about these systems after they've already been processed by them. History doesn't have to repeat if you study it first. Subscribe. The answers aren't hiding in the future. They're written in the past. Position accordingly.